Welcome back to the Market Insights webinar. This is Kevin Prince from BMO Exchange Traded Funds. Always a pleasure to have you at our session each week on Fridays at 1 o'clock. This week's topic, and I'm really excited about it, we're going to talk about some of the innovations that ETFs have brought to the marketplace. And I think over the last 25 years, there's been a significant change in the way people can build portfolios, and we're going to hopefully highlight that for you today. But before we go into that, let me do a few things. Number one, I'm going to do a couple disclaimers. First and foremost, first of all, let me introduce my guests, then I'll do my disclaimers. Apologize. So most of us here from InvestorLine, Mustafa, thanks for joining us. Alfred, thank you for joining us from BMO Exchange Traded Funds, and Danielle from BMO Global Asset Management. So it's quite a good crew today, and really going to give you some good overall insights towards the overall market, and specifically a tilt towards ETFs. Now, when I say insights, talk about a bit of disclaimer here. What am I saying? Not going to provide recommendations, and we're not going to provide specific advice. Ultimately, what we want to do is give you some insights to the market, insights around ETFs to help you be more educated around investing. And let me do a quick favor for InvestorLine too, because they're joining us today. So with InvestorLine joining us, I want to say the same thing to them. We're not going to provide specific advice, nor are we going to provide specific recommendations. But really to provide you information to help you be educated and be a better investor out there. So let's start off with a little bit of promotional offer. Mustafa, you're on the line, and maybe you can share with our audience here a little bit about your promotional offer, please.
Hey, good afternoon, Kevin, and happy Friday to our audience members out there. Once again, thank you, Kevin, for having me on today as a guest speaker for BMO InvestorLine. Look, I just wanted to take a few moments before we dive right in to acknowledge what is happening here in the industry, particularly around the explosive demand and the impact on wait times across the industry. I know our audience here are experiencing longer than normal wait times, regardless of which online brokers they're with. But the good news is that here at InvestorLine, we've quadrupled the rate of hiring, and over the next month, we're increasing the number of agents answering phones by 50%. So we do have a roadmap of a 10-minute wait time for our self-directed platform by mid-March, which is why we're so confident in our offering of giving our audience members $4.95 trading on equities and ETFs for a limited time, or up to $2,500 cash back on one of our most innovative online trading platforms, Advice Direct, by opening and investing in a new account. Back to you, Kevin.
Oh, thanks for that. And you know what? Good to hear that the industry is really growing out there, because that's effectively the reason why we started these webinars in the first place, to help give the industry itself some insights as they choose to invest by themselves. But before we go down the path of the topic of innovations, we always like to kick off with some tools. And if people are going to invest by themselves, maybe Mustafa, you can help us give some insights of what kind of tools you offer on Advice Direct there.
Yeah, absolutely. So one of the really interesting features regarding Advice Direct is the recommendations given on a particular stock, where we break down the fundamentals and give it an overall score. It also addresses the market sentiment, whether it's negative, neutral, or positive. And we take this one step further by showing other companies within the same sector, but also within the same industry. So you can compare the scores and sentiment of stocks in similar baskets. Now, I don't know about you, Kevin, but if you were to ask me about how many ETFs and equities I could list, it would probably be, I don't know, a couple of hundred maybe. Our platform provides intuitive trading on thousands of securities traded across the major North American exchanges. So when we do take a look at the next slide, just on to the next slide, Kevin. Yeah, great. So clients can look at a particular ETF and in one snapshot, compare the management fee, asset allocation, performance, and rating. Which really helps when you're looking at a wide variety of ETFs out there. Back to you, Kevin.
Yeah, thanks for that, and good insights and tools, and help people be there to make those informed decisions. So that's what we like. So let's talk about now the core topic, and the core topic today is about the innovations in ETFs and about building those portfolios and the tools around it. Now, Alfred, you're on the line here, and you maybe give us some background on, where did ETFs initially come from? And kind of give us the background around the equity aspects around ETFs as tools.
Sure. We've seen a lot of innovation in the ETF industry, as you know. But initially, a lot of that innovation started, over 25 years ago when traditionally the first equity ETFs were designed to track a benchmark indices. So, typically when you turn on the news, when you listen to the financial segment, you'll very often hear them quote, what the Dow Jones, the S&P 500, or the NASDAQ, or with Canadian financial news, the S&P TSX Composite. You'll very often hear them quote, what that index did on the day. So in ETFs, or the traditional benchmark tracking ETFs, what they're designed to do is be a basket of securities that track these specific indices. So, the innovation with this is that prior to this, it was very difficult to buy the market, but with an ETF, you essentially could get exposure to the overall market. So getting exposure to hundreds of securities in the exact same weighting and the exact same securities that are held in the index through one single trade. So through that, investors were able to get not only market exposure, but also get market exposure at a very cost-efficient rate as well.
Thanks, Alfred. And what I also like too is that two nice things. A little bragging point for Canada. Canada launched the very first ETF in the world, so nice to see that Canada itself brought the innovation out. The other thing I'm going to quickly highlight here too is what I like about this is that, with the launch of the US, Canada, emerging markets, and EFI, you can start to see how you can start to build portfolios together with the North American market, the international markets, and emerging markets coming together, those critical tools to build portfolios. Alfred, another key innovation and a critical tool for building a portfolio is around fixed income. And I'll highlight that this was also an innovation here in Canada, the very first fixed income ETF in the world. Alfred, give us what that meant to investors out there when ETFs brought out fixed income ETFs.
Yeah, I would say, the fixed income ETF has been very innovative because when you look at the underlying fixed income market, the bond market is, what we call an inventory-based market where it's very specific to, if you buy a bond right now, there's no guarantee that you could find the same bond, let's say even a week down the road. So with the fixed income market, there's a lot of other nuances too. So the bonds trade at wide bid offer spreads. In addition to inventory problems, it's a very opaque market. So you don't know where bonds have traded. You don't know where the bid offer is. But with an ETF, it addresses a lot of those shortcomings. So with an ETF, you know that where the bid offer is at all times. You don't have inventory related issues because it's essentially a standardized product that people could essentially keep buying and scale up their positions. But it's also very transparent as well. So it addresses a lot of the shortcomings of the market. ETFs have also been very popular in the fixed income side over the last 10 years because as interest rates have come down lower and lower, it's been very difficult for active managers to outperform the market. So with a fixed income ETF, it allows investors to get exposure to the fixed income market, but at very cost-efficient rates as well. Because if you can't outperform the market, you may as well just minimize your cost. And an ETF allows investors to very efficiently do that.
Thanks, Alfred. And I want to quickly highlight too that it's not just investors using these tools. We quite often see a lot of institutions use these tools because they are that efficient, as you mentioned. Yeah, Alfred, just stay with you for a little bit more. Another innovation, especially from a Canadian perspective, that came to the marketplace through ETFs is currency hedged or USD ETFs, so currency options on ETFs. Now that's become a key part of portfolio construction. Tell us why.
Well, when you're investing internationally, one thing that you have to consider is that you get exposure to two things, the return of the underlying securities and then the return of the currency as well. So there's two components of returns. So very often investors want only the return of the securities. So by using a currency hedged ETF, that essentially allows you to get exposure to only the securities. So the best way to look at this is with a currency hedged ETF to the S&P 500, for example, you're getting exposure to the S&P 500 as if you were a local investor in the US. So that's the easiest way of looking at a currency hedge product.
Yeah, and I think it really helps people decide whether you want to hold that marketplace or hold that marketplace, with a hedged or a currency exposure plus the underlying. One quick thing on this, of course, is the very first ETF that was hedged was also launched here in Canada too. So a little bit of theme there, but not intentional. It just worked out like that. Alfred, still staying with you, because one of the things we've seen in the marketplace is a lot of demand for income out there. And certainly what came into the marketplace is, solution sets like cover calls and option-based strategies to help allow people access enhanced income. Walk us through what that means for investors.
Yeah, so with cover call ETFs, this is a strategy, not necessarily an innovation of Canada, but Canada was definitely very critical in terms of putting this on the map and popularizing cover call ETFs. But to your point, I find a lot of Canadian investors particularly are income focused, but also very conservative in nature as well. So cover call strategies tend to be popular with Canadian investors because it allows investors to get exposure to the underlying stocks, but also enhance their yield as well. So what it entails is buying the stocks and then selling call options against these positions. So you collect the call premium and get that additional income above and beyond the underlying dividends as well. So it's a good way to enhance the yield in the portfolio. The issue of running covered call strategies on your own is that it's a very cumbersome process and it's very laborious where, every time the options expire, you have to roll those options. So it's very labor intensive strategy. So with a cover call ETF, the beauty of this is that by buying the cover call ETFs, it's basically a one-ticket solution, and it's professionally managed by a portfolio manager for you. So you don't have to worry about rolling those options.
Exactly. So it simplifies an investment portfolio, but plus gives them that income enhancement people are looking for out there. Hey, let me still stay with you, Alfred. You're very popular today. Hey, Alfred, smart beta, that's a terminology we use in the industry. What does that mean for investors, and why should people look at that as a part of their portfolio consideration?
Well, with smart beta ETFs, I think, in my opinion, I think this has been one of the better innovations in the ETF market over the last 10 to 15 years. Smart beta investing is essentially, combines the benefits of active investing and also passive investing. So it takes elements of active investing, such as, overweighting the certain stocks that exhibit a certain characteristic. But like passive investing, it's very rules-based and very transparent as well. So when you look at certain factors that smart beta ETFs expose you to, there's dividend-based ETFs, which essentially, instead of taking a market cap weighted approach, it weights to companies that pay a higher dividend. There's also low volatility ETF, which essentially is weighting to stocks that tend to be more conservative. There's also momentum stocks, higher quality stocks that focus on blue chip stocks and blue chip investing. So there's many different factors that smart beta ETFs can overweight. So I think the good thing about smart beta investing is that when it comes to investing, it's not a one size fits all strategy. So a market cap weighted ETF may not be the best approach for certain investors. If you need a little bit more income, maybe a dividend weighted ETF is more practical for you. So smart beta ETF allows you to adjust your exposure in order to target those specific factors that you want in your portfolio.
Yeah, and I think that's the key thing. What's your individual objective? So if your objective is less risk, more income, or outperformance, whatever the objective is, there are actually strategies out there that can align back with your objectives too now. So it's not just a broad market anymore. Oh, and then on sector ETFs, Alfred, just quickly, give us a little bit about sector ETFs in the marketplace.
So sector ETFs essentially focus on a specific part of the market. So certain companies that belong to the same industry, for example, with this slide, real estate investment trusts. So a sector ETF will hold, all companies that are involved in that real estate investment trust area. So it's a good way to target a specific part of the market. So, at different points of the economic cycle, certain sectors outperform others. So it's a good way to play that economic cycle. Also, if you think a sector is going to outperform at a certain time, it's a good way to quickly get exposure to that sector, but minimize your company-specific risk because you are holding a diversified basket of securities.
Yeah, and I also like sectors for the concept of, versus stocks. So you can have a sector versus a stock. So if you want to hold RioCan, certainly you can buy it, but you can certainly buy an ETF that gives you that sector exposure too. Now, Danielle, I know I've been patiently waiting. So let me bring you in on this. One of the things you've been working on, you've been spending some time on is, disruptive innovations, because it's kind of funny. We talk about innovative in ETFs, and it's certainly been a big part of the marketplace. But now ETFs have even gone one step further and started focusing on the innovative part of the marketplace itself. Talk to us about that, please.
Right, Kevin. Well, investing in disruptive innovation is a really exciting and new way of viewing the market. So what do I mean by disruptive innovations? Well, these are new technologies and emerging themes that are going to have very large scale and very powerful global impacts across sectors, across industries, and across regions. So from an investment standpoint, the companies exposed to these innovations will probably benefit by ways of increased revenues, market cap creation, as the innovation or the theme evolves and gains traction. And why investing in innovations has become so popular over the last year is because the pandemic has really turbocharged a lot of these innovations. And why? Because innovations solve problems, right? They make our lives easier. And with the pandemic came a lot of problems. So here's an example: next generation internet innovation. We all know the internet has made our pandemic lives a lot more comfortable. Like, I can't imagine being locked down in my home without my Netflix subscription or without the ability to order things on Amazon. Fintech innovation. I can do a lot of my banking online, make touchless purchases with my phone. During the pandemic, a lot of places actually stopped accepting cash. So just a few examples how fintech innovation has really begun to change the way we make payments and do our banking. The genomic revolution. So this started with the sequencing of the human genome, and the developments coming out of genomics are extraordinary. And here's an example that we're all familiar with: vaccine development. So how quickly we were able to develop a vaccine is remarkable. And this is thanks to genomic innovation. And autonomous technology. So things like artificial intelligence, drones, robotics. Robotics have been used this year because they help with social distancing. And if you think about assembly lines and people working in tight quarters, robotics are being used in these situations to allow for distancing. So this is just one example, but Kevin, it's still early innings for these innovation platforms. We're just getting a preview as to what's to come in the future for these, so it's pretty exciting.
Well, thanks for that. You know what I want to do, if we can, because this is probably some new terminology, disruptive innovations. Can you walk us through that terminology a little bit more? And I know you got a good example here, so let me bring that up.
Right. So how do we identify what is an innovation? Well, I like to use the telephone as an example. So this was a disruptive innovation that we've all witnessed played out. So things like cost curve decline is really important. So as the technology or the innovation drops in price, it becomes more widely used, therefore impacting everyone, no matter where you are or who you are. Cross-sector and global adoption is also really important. So it doesn't just impact one subset of people or one industry. Everyone, everywhere will benefit. So the telephone certainly fits the bill for that. And then lastly, a new innovation will develop off the mature innovation. And Kevin, this is where I think it gets really exciting and interesting. So if we think about the telephone, well, we now have the smartphone. And now, what innovations are going to come out of the smartphone? Things like fintech. Your smartphone is now your digital wallet. Next generation internet innovation. You can change the temperature of your house with your phone. You can order groceries to your front door with your phone. So again, from an investment perspective, these innovations are going to have huge growth potential as they evolve and they grow. And then the companies exposed to these innovations will certainly benefit from this growth. But Kevin, I think I know you secretly miss your BlackBerry.
I do. I want the buttons back. I don't know. I just want those buttons back. Anyway, thanks for that, Danielle. Staying with you, Danielle, because when we're talking about portfolio construction and putting things together, you talked about innovation, but also we talked initially about core holdings like the S&P 500, the whole works. How do you bring all this stuff together?
Right, great question. So that's probably the most important question. You know, where do these fit in a portfolio? Well, kind of how I described in the last couple of slides. Innovation is growth. So think of these, this is growth investing. Innovations can be used as a core portfolio holding for a growth investor who has a long time horizon. And this might surprise people who might have thought of these as more quick or tactical trades. But like I said, we're really in the early innings of the development and adoption of these innovations. So a longer time horizon will benefit as the growth theme really plays out. And as a core holding, and you mentioned, you know, the S&P 500, we like to advocate for diversification. And many of these products are really diverse among sectors, among regions. You know, a lot of them are global. To really capture that innovation, you have to look outside, like to every country, not just the US. Again, though, of course, do your research, always look at that ETF, look under the hood and look at what it's holding. Secondly, you know, they can be used also as a tactical allocation. And an example I use is if you're an investor who wants to maybe make a play on vaccine development, you can look to something like a genomic innovation ETF and add that to kind of tilt your portfolio. Another really popular one we're getting a lot of questions about is 5G. You know, investors want to know, how can I invest in companies that will benefit from that 5G rollout? You can look to things like next generation internet, which would have companies in there that will benefit from 5G as it grows and evolves. So some investors who are not growth investors, who might be more focused on dividends or income, innovations can also be used as a smaller satellite or as a growth sleeve in a portfolio that might be, the core of that portfolio might be more focused on stability or income. But you know, the great thing about using an ETF to add an emerging trend or an innovation to your portfolio, you minimize that single stock risk and you maximize exposure to the trend, because you'll be holding all the companies who benefit from that trend, not just one or two.
Thanks for that, Danielle. I mean, that's some good perspective of how to use portfolio construction, as well as bring new elements of to a portfolio. Now, just to give a little shout out there, if you want to do some homework and take a look at innovations out there, where does somebody start in that space?
Right, so innovation ETFs are really growing in popularity. Investors are learning more about them, they're reading more about them. There's a lot of ETFs out there to choose from already, even though this is a kind of a newer way of looking at the market. And probably one of the most popular right now is a firm called ARK Invest. So they're an active manager in the US. They've made some really big bets on innovation companies. These are very concentrated and highly active portfolios, but they're gaining a lot of investor interest. They had a very, very strong, good performance in 2020. So that's catching a lot of investors' eyes. Emerge ETFs is up here in Canada, and they're actually using ARK as a sub-advisor. So essentially they're wrapping that ARK ETF strategy and then just listing up here in Canada. And then on the index side, or the passive side, BMO ETFs listed 5 innovation ETFs last month. Evolve is another firm who has a suite of innovation ETFs, and Horizon has a few innovation tickers as well. But we always want to remind our listeners, our viewers, do your homework. What's so fabulous about an ETF is you can see what that ETF is holding. You can read its investment strategy. Everything is available online, the click of a mouse. So do your research, make sure things are right and suitable for you. That's it for me on innovations. Before we close out, I'd love to send it back to Mustafa, who is going to give us some insights on an offer.
Thank you, and you know, it's always refreshing to hear your take on innovations around ETFs. And again, you know, for our audience members out there, if you'd like to have a chat with me about our promotional offers, you know, do reach out to me via LinkedIn, or you can also Google my name and schedule an appointment through my landing page. And you know, we do also have the offer codes on display here on this slide, so you can always use these offer codes when opening an account online. Thank you.
Great, thanks for that, Mustafa. Now I think we have some time to look at some questions. So, are the policies of the Biden administration consistent with what portfolio managers expected? Have there been any surprises? Alfred, what do you think of that?
No surprises in general. We knew the Biden administration was going to come in with, clean energy being very important as part of their platform. Also, stimulus, we knew that they were going to rely on a lot of stimulus in terms of getting the market going, in terms of, getting the economy going as well. Also a big focus on ESG mandates and, environmental, social, and governance, and being a big part of their platform as well. So no surprises at all. We knew that this was going to be a big part of their platform.
Thanks for that, Alfred. Okay, our next question. Based on the respective fact sheets, ZEB Clean has a 52-week high to low range of approximately 8.4%, while iClean has 52-week high-low range of around 76. Given the similarity of the main holdings, what would explain this large difference? I can answer that. So ZEB Clean, that's the BMO Clean Energy ETF that you're referring to here, it was listed 3 weeks ago. So that 52-week high to low is only capturing 3 weeks, where the iClean ETF has been on the exchange for a few years now. So it has that full 52 weeks of data to look at. So thanks for the question. Okay, next question. What is the maximum length of time a limit order can be set before having to renew the order if the order could not be filled at the limit price? Mustafa, maybe I'll send this question over to you.
Thank you. Yes, when entering a limit order, you can specify whether it's a day order, which expires at the end of the day, or you can select up to 30 trading days out before the order expires. You can also amend that order instructions at any time, whether that's quantity or price. Thanks.
Perfect. Thank you for that. Have any more questions? Oh, perfect. I noticed BMO launched new ETFs in the last week. Can these be traded through BMO Investor Line? Mustafa, I think that's another question for you.
Absolutely.
That was an easy answer. So yes, you can. All available BMO Investor Line. And that is it for questions. Thank you for joining us. Always great to have you here, and keep those questions coming. Make sure you keep sending them in. We love getting them. And actually, the topic for next week's webinar was inspired by the questions that we have been getting around preferred shares and preferred share ETFs. So be sure to tune in to that next Friday, same time, same place. Have a good weekend, everyone.